Let's start with geopolitics. The war of words between Trump and Kim Jong-un is certainly escalating. Do we get to a point where the escalation causes market participants to reduce their risk exposure to Asian assets?
I think, Mark, we've seen over the last sort of month or two, on a sort of two-weekly basis, risk on, risk off, on reduction on, depending on the news flow out of North Korea. But I expect there'll be a lot of rhetoric up until the party conference in China in October, and then after that, with Trump's visit, I think people are waiting to see if there's a solution after that.
Asia is your preferred region within EM, isn't it? You prefer North Asia over ASEAN, particularly China and India. What's the rationale behind that call?
South Asia outperformed when emerging markets wasn't doing well. It had a higher growth rate and got quite expensive. And now we're seeing the delta back into North Asia, particularly in China, where we're very positive. We've been positive on India for a while, and that continues to do well, particularly locals buying the Indian market. But China, I think people have underestimated the growth in China and the bottom-up reform from SOEs, and it was a cheap market. So we think it continues to do well this year.
Any concern about the currency and its strength and fluctuations perhaps having implications for earnings for Chinese companies or indeed inward investment?
We think we shouldn't get too much impact on the currency moves in China on earnings. Bottom up looking, the free cash flows of Chinese companies are doing very well, and we think that will continue relative to what's been happening in the last few years. The worry of currencies now, with the dollar a little bit stronger over the last sort of week or so, if it continues, that will definitely impact some of the more emerging parts of the index, particularly Mexico, Indonesia, Turkey, South Africa, potentially Brazil. So we expect this dollar rally to be short-lived.